All right, welcome to The Explainer. Today we're diving into a really fascinating and maybe a little unsettling financial thesis. It connects the dots between these new corporate digital currencies and a potential complete reset of our entire monetary system. Let's get into it. So, have you ever really thought about your money like that, like a melting ice cube? It's a powerful image, right? And it's exactly where we need to start. We're going to kick things off with this idea from our source material that basically asks, is the cash you have in the bank really as safe as you think it is? Okay, so the first piece of this whole puzzle, according to analyst Lynette Zang, is this. There's a huge fundamental shift happening right now, right at the very core of the global financial system. Something is changing under the surface. For decades, the whole system was pretty stable. And why? Well, because you had these reliable, long-term buyers of U.S. debt. Think foreign governments, big banks. They were the bedrock. But here's the kicker our source points to. Those traditional buyers, they're starting to walk away. And this chart here really shows you what's going on. You can see that shift away from those stable, long-term players. And according to this thesis, that's not just some small change. No, that's the crack in the foundation. It introduces a massive vulnerability into the entire system. All right, so if that's the crack in the foundation, what's the earthquake that's going to shake it? Well, this is where it gets really interesting. A brand new financial tool has just entered the scene. And the thesis we're exploring identifies this tool as the main catalyst, the thing that's going to trigger a massive disruption. We're talking about stablecoins. Now, don't get these confused with something like Bitcoin. They're built for stability, pegged one-to-one with a currency like the dollar. But here's the part that's absolutely crucial for this argument. They can be issued by giant corporations, think Amazon, think Walmart, not just the banks we're used to. And we are not talking about small potatoes here. Look at this number. The source material is pointing to projections that this market is going to absolutely explode. From around $125 billion today, all the way up to $2 trillion by 2028. That is a gigantic shift in money. So how does this actually work? How does it lead to the big crisis? Well, the theory lays out this really interesting three-step process. Step 1, your savings, my savings, start moving out of traditional bank accounts and into these new corporate stablecoins. Okay, so what happens then? Step 2, that pulls a ton of money out of the banking system, which actually creates deflationary pressure. And this is the paradox. Step 3, the central banks see this deflation and they have to fight it. And what's the only tool they really have? Yep, printing massive amounts of new money. They're forced to inflate. Now, you might be thinking, this sounds crazy and unprecedented. But according to the source we're looking at, this has all happened before. It's basically a modern-day replay of a really chaotic and kind of wild period in American banking history. Just listen to this quote from 1893. Men went to bed rich and woke up penniless. That's describing something called the wildcat banking era back in the 1800s. It was a time when private banks printed their own money, leading to failures, chaos, and what the source calls wild and reckless speculation. Sound familiar? And this is the parallel the source is drawing, laid out side by side. In the 1800s, you had private banks issuing paper notes. Today, you have private corporations issuing digital coins. The core idea, the argument goes, is exactly the same. Private companies creating money completely outside the control of the central banking system. Okay, so what makes this possible today? Well, the source points to a specific legal framework that it calls a critical piece of the puzzle. It talks about things like safe harbors and exemptions, and the argument here is that these rules are basically designed to protect the companies issuing the stablecoins from the fallout if things go wrong. So who's left holding the bag? According to this thesis, it's you. The public bears all the risk. So, you put all these pieces together, the shifting debt market, the rise of corporate stablecoins, the historical parallels, the legal framework, and it leads us to the dramatic endgame of this thesis. And the claim is a big one. That this isn't all just happening by accident. That it's a mechanism designed to achieve one very specific and frankly world-altering outcome. And here it is, straight from the source, Lynette Zang. She says there isn't one teeny-weeny doubt in her mind that stablecoins will be used to usher in the hyperinflation. I mean, you can't get much clearer than that. The argument is that this is the chosen tool, the Trojan horse, to devalue the currency faster than we've ever seen before. And that right there is the so what. This is why this whole thesis matters. It's not just a debate about a cool new technology. No, the argument is that this is a deliberate plan to solve the world's massive, unpayable debt problem by basically hitting a reset button. a reset that wipes out the value of everyone's savings in the process.
So, okay, if the whole system is designed to fail, what's the escape hatch? Where do you go? Well, the source material doesn't just point out the problem, it also proposes a solution. And it's one that's rooted in assets that exist completely outside of that system it's critiquing.
The term used is sound money. And what does that mean? Well, think about a dollar in your bank account or a share of stock. Those are basically IOUs. They rely on a bank or a company to be solvent. That's counterparty risk. The source defines sound money as something totally different. It's a real, tangible asset, like physical gold or silver that you hold in your hand. It's not someone else's promise to pay. And to show you just how high the stakes are, the source presents this absolutely incredible valuation. Look at the difference between the spot price, what you pay today, and what the source calls the fundamental value. The argument is that the current market price for precious metals is being held down, and that in a real crisis, their true value would be revealed to be orders of magnitude higher. So at the end of the day, the takeaway is this. In a currency reset, when the value of paper money is wiped out, the only thing that's claimed to preserve your purchasing power are these tangible assets. The whole idea is that they act as a kind of financial bridge, an asset that can actually carry your wealth over the chaos from the old system to the new one. And really, that's the huge question this whole thesis leaves us with, isn't it? As these new digital currencies completely reshape our financial world, what truly holds value? It forces you to take a step back and ask what money even is anymore in this crazy digital age.